It's a radically different world from the world we started in. I suppose it will have its opportunities, but it's also going to have some unpleasant episodes.
We're in the midst of a financial world that's increasingly volatile and unpredictable. Investors are on edge, unsure what the future holds. But what if there was someone who could see through the noise and offer a clear-eyed perspective? Someone like Charlie Munger, the legendary investor and right-hand man to Warren Buffett. Today, we'll dive into Charlie Munger's final warning for investors in 2024. With decades of experience and unmatched wisdom, Munger has a message that every investor needs to hear. Why does Charlie believe it is a challenging period to invest in the stock market, and what solutions exist? Regarding the initial query, Charlie simplifies the issue into three primary aspects. He initially addressed the first aspect during the Berkshire Hathaway shareholder meeting in May.
I think value investors are going to have a harder time now that there's so many of them competing for a diminished bunch of opportunities. So my advice to value investors is to get used to making less.
The primary issue, according to Charlie, is the overwhelming abundance of financial analysis. When Charlie and Warren initially began investing, accessing financial data and the stock market as a whole was much more limited. However, as investors began reaping significant profits, and with the market becoming increasingly accessible due to technological advancements in the past 30 years, there has been a considerable rush into stock market investing. This influx attracted more participants, resulting in heightened scrutiny and analysis of publicly traded companies. Moreover, the ease of swiftly entering and exiting positions across global markets has contributed to an inundated environment. Consequently, discovering exceptional investment prospects has become exceedingly challenging amidst this heavily analyzed landscape. Often, the extensive scrutiny makes it highly improbable to find undervalued, high-quality businesses. So, that's Charlie's initial point explaining why being an investor is particularly challenging in this period. Delving deeper into why the current environment poses additional difficulties, it's primarily due to the escalation of interest rates. When interest rates increase, our companies encounter greater difficulty repaying their loans and accessing debt for rapid expansion. These challenges typically exert pressure on profitability and consequently affect stock prices. This situation starkly contrasts the unrestrained growth observed over the past decade, where nearly everything was on the rise. Undoubtedly, this factor significantly influences the current scenario. Additionally, there's the consideration of the risk-free rate. As interest rates climb, newly issued government bonds offer more attractive returns. Hence, in a high interest rate setting, a substantial amount of institutional capital naturally shifts away from stocks towards the security of bonds. This movement further impedes the rise of stock prices. It's akin to the stock market transitioning from moving effortlessly with the current to now struggling against it. So, these are the three significant factors influencing the scarcity of opportunities: the saturation within investment analysis, the broader impact of rising rates on businesses, and the movement of institutional funds from stocks to bonds. Confronted with perhaps the most challenging investing period in human history, what actions can we take? One aspect we can all focus on is maximizing our learning to stay updated on the stock market and economics. Exercising patience and anticipating the ideal movement is the key strategy. As per Charlie's advice, achieving wealth significantly relies on seizing those rare lucrative opportunities occurring roughly every 5 to 10 years, rather than settling for more frequent mediocre investments. Warren Buffett illustrates this with a punch card analogy. He suggests that in one's lifetime, you only have around 20 investments to make. With each investment, a hole is punched on the card, and once all 20 holes are punched, your investment choices are fixed for life. This analogy emphasizes the importance of waiting for significant opportunities, as genuinely good chances arise infrequently. If we focus on my lifespan, which began in 1995, there have been only 3 significant stock market opportunities: the dot-com crash, the 2008 global financial crisis, and the 2020 COVID crash. Within 28 years, there have been 3 instances, and realistically, I've been an adult for just one of those periods. Hence, the punch card analogy offers a profound perspective. As Monish P. has highlighted, the majority of your returns usually stem from 3 or 4 major successes over time. Consider this: Warren Buffett mentioned that the majority of Berkshire's success originates from around 12 exceptional investments. Despite making hundreds of investments across decades, when factoring in these 12 outstanding investments alongside numerous average ones, Berkshire still manages to achieve an average annual return approximately double that of the S&P 500. What does this teach us? It underscores the importance of diligently seeking these significant winners, the long-term compounders, and seizing the opportunities they present. This strategy mirrors Warren and Charlie's approach. They avoid numerous trades per year and instead exercise patience, conducting thorough research, comprehensively analyzing financial statements, ensuring a deep understanding of the business, verifying its competitive advantage, assessing the strength of the management team, and scrutinizing the valuation to ensure a safety margin. Subsequently, when the opportune moment arises, they make substantial investments. Their investment in Apple perfectly exemplifies this patience and pursuit of lucrative opportunities at the right time. So, according to Charlie, in the initial stages, they realized that among these prominent 7 to 10 tech companies worldwide, businesses typically need to engage with at least 2 or 3 of them due to their significant market presence and essential products in our own modern society. Reviewing the historical price-to-earnings or PE ratios of these major corporations around 2015 to 2016, particularly when Berkshire Hathaway acquired Apple, reveals an intriguing observation. Amazon exhibited an exceedingly high PE ratio. Meta's ratio exceeded 50, while Google and Microsoft ranged in the 20s or 30s. However, Apple stood on a similar footing with these companies, but boasted a significantly lower PE ratio, approximately between 10 to 13 times earnings. This rarity presented a substantial opportunity, leading Buffett to invest around $30 billion, which has now grown to approximately $180 billion. Another instance is Berkshire's recent venture into the Japanese trading houses. This represented another significant opportunity that required meticulous research and analysis. When the opportune moment arose, they capitalized on it by making substantial investments. For instance, Berkshire could issue yen-dominated bonds at an interest rate of around 0.5% and then invest the proceeds in the Japanese trading houses, yielding around 5% in dividends, a relatively secure move. Such rare opportunities are infrequent. As noted by Charlie, it demanded considerable patience, but when the moment arrived, Berkshire seized it eagerly. This approach encapsulates the essence of investing in an exceptionally challenging market period. Even with interest rates working against us and the investment landscape being saturated, it's crucial to remember that constant investing isn't a necessity. The beauty of the value investing approach lies in the ability to relax, exercise patience, and anticipate those exceptional opportunities. Warren Buffett emphasizes one significant aspect. Despite the current challenging environment for generating profits, opportunities will inevitably arise, driven simply by human nature.
I would argue that there's going to be plenty of opportunities. New things coming along don't take away the opportunities. What gives you opportunities is other people doing dumb things.
Seth Klarman has echoed this sentiment lately. Despite the crowded nature of the field, the collective behavior of humans, where they tend to follow the crowd, being greedy or fearful together, can still present enticing opportunities. Even in the case of the largest and most thoroughly analyzed companies, conducting thorough research and exercising patience can lead to identifying those rare moments, focusing on the 3 or 4 significant investments that will predominantly shape your wealth over a lifetime. However, that summarizes Charlie's current perspective on investing in this economic climate. Certainly, concluding the discussion on investing during challenging economic times, it's evident that the landscape poses various obstacles. Factors such as saturation in investment analysis, rising interest rates, and the movement of institutional money significantly impact the scarcity of opportunities. However, amidst these challenges, key insights from renowned investors like Warren Buffett, Charlie Munger, Seth Klarman, and others emphasize the importance of patience, thorough research, and the pursuit of rare, lucrative opportunities. The value investing approach underscores the significance of waiting for those pivotal moments that shape wealth over a lifetime, rather than engaging in constant, mediocre investments. Despite the difficulties, the cyclic nature of human behavior, where individuals tend to follow herd mentalities of greed or fear, can unexpectedly unveil enticing prospects. Ultimately, maintaining a disciplined, patient approach while remaining vigilant for those rare opportunities is crucial in navigating through these trying economic periods. As highlighted by seasoned investors, success often stems from a handful of significant investments, emphasizing the quality and timing of choices over sheer quantity. In essence, amidst a challenging market, the focus remains on seizing those few remarkable opportunities that define long-term success in the realm of investing.